Good afternoon, everybody. Welcome to the SCORE presentation on financial basics. Presenting today will be myself, Richard Brooks, and Chris Analazar. And next slide, please, Chris. Okay, a little bit about SCORE. We're a nonprofit organization dedicated to helping small businesses get off the ground, grow, and achieve their goals through mentoring and education. We've been doing this for over 50 years. Our mission is to foster vibrant small business communities through mentoring and education. We aim to give every person the support they need to thrive as a small business owner. Okay, what do? We provide mentoring either face-to-face or remotely, email, telephone, video, just about anything that works for you. We can make it work for us. We also do workshops just like we're doing now, and we will do a board of advisors for your business. We don't do a board of directors because that is generally compensatory. In other words, most boards of directors are paid. Whereas a board of advisors, we do it as part of our mission. Everything we do is free. There are no charges from SCORE for one-on-one mentoring, for the webinars, for anything else that we do. We get part of our funding from Congress administered through the SBA. There are 10,000 volunteers around the country in 240 chapters. And if we don't have the expertise you need within our chapter, we will go outside the chapter to find a mentor that can do it for you. Okay, well, how do you find a SCORE mentor? You go to the score.org website or the score.org/Cleveland website. The image in front of you right now is the Cleveland website. So that would be score.org/Cleveland or score.org, either one. And you'll see in the upper left-hand corner, right below where it says Cleveland, it says find a mentor. All you have to do is click there. You can see all the mentors that we have in the Cleveland chapter, or if you're not finding somebody that fits your needs, there's another link there. Once you click the find a mentor link that says, please assign a mentor to me, fill out the screen, your name, contact information, and exactly what your business requirements are, and we will get a mentor to you as quickly as possible. And with that, I'm turning it over to Chris.
Thank you, Richard. So we are going to start talking today about how to make more money in your business. The beginning of how to even have that discussion is really going to start with establishing some basic financial vocabulary. Once we are all in agreement and have some of that vocabulary, we're going to learn how to calculate profitability, which is very important to know for your business to make decisions. And then we're going to use that profitability to calculate what's called break-even point. We're then going to talk about different types of accounting that you can use for your business. We're going to talk about some different financial statements, and we're going to talk about the variety of financial service providers that are out there and help you, with understanding the difference between those different types of providers. So getting started, we really are going to be talking about two basic things. We have money coming into your business, and we have money going out of your business. When we talk about money coming into your business, it's usually referred to as revenue. Revenue is all money coming into your business, and your expenses is all the money going out of your business. So these are the two most important things to keep track of. If we subtract all of the expenses from all of the revenue, that's how we figure out how profitable a business is. So we do need to have detailed and accurate accounting of the monies coming in and the monies going out to be able to calculate that. So again, there are other ways that money comes in, like through interest on a business checking account or savings. But in general, your sales, whether it's a product or a service or whatever your business is selling, your sales is what generates your revenue. And your costs, all of the things associated with the expenses of your business, is all of the money going out. So again, we're going to look at all the money coming into your business, and we want to look at all the money going out of your business. If you look at finances as just these two main moving parts, it gives you a good foundation to not feel like all of this is so overwhelming. It's money in and it's money out. And how do we categorize those two parts? So we're going to start with the expenses. Expenses are broken down into two categories. We have fixed expenses and we have variable expenses. Fixed expenses are exactly what it sounds like. They are the same regardless of your sales. They're the same month to month or year to year. They don't change if you sell more, if you sell less. These are things that you can know are going to be consistent on a monthly basis. The other type of expense is a variable expense. And also, what it sounds like, it varies according to your sales. So, as your sales increase, your variable expenses increase. As your sales decrease, your variable expenses also decrease. So, as your business fluctuates, your expenses in this variable category will also fluctuate. Some examples of fixed expenses are things like utilities, auto loans, your rent, your insurance, loans for equipment that you might have, and salaries for employees that are not associated with the products you're selling. These are like an office manager or an HR person or people that are on salary and not directly related to the sales of whatever your business is selling. Variable expenses, again, they vary based on how much sales. So an example is commissions. The more a salesperson will sell, the more commission you're going to pay that person. So that expense will go up as they sell more. Marketing, raw materials, direct labor, things like shipping charges. If you're selling more product, you're shipping more product, your shipping charges are going to go up. You sell less, you ship less, that cost would come down. So we're going to use this concept of fixed and variable expenses to start looking at how to calculate profitability. So we're going to use a company model called Puzzle Mania. They, like the name sounds, they make puzzles, and their fixed expenses are what they pay the same every month. Their rent is $3,000. They have telephone, insurance, salaries, internet, and utilities. So every month, whether they sell a million puzzles or no puzzles, it doesn't matter. They still have to pay $9,070 for their fixed expenses. That expense is there regardless of their sales. Now, we're going to look at the variable expenses, and you'll notice something very different. Variable expenses are expressed as a percentage because, like I said, they go up as your sales go up and they go down. So it's not a fixed amount, it's a percentage of your sales. So in Puzzle Mania's scenario, their raw materials are 15%. Their wages, so that's direct labor that's associated with actually making the puzzles, is 20%. Their credit card fees are 3%, shipping 3%, and marketing 8%. So their total variable expense is 49%. So now we're going to use these numbers to calculate profitability. Puzzle Mania sold 1,500 puzzles at $20 a puzzle in October. So if we multiply 1,500 puzzles times $20 each, we see their revenue for October was $30,000. Now we're going to take that $30,000 and multiply it times 0.49. That's how we know what is 0.49% of that sales for their variable expense. That's $14,700. And we also want to subtract their fixed expenses, which is $9,070. So if we subtract both the variable expense and the fixed expenses, we see that's left over is $6,230. That's their profit for the month of October. They've paid all their bills, they've paid all their expenses, and now that's what's left over at the end. If we divide 6,230 into their total sales for the month of 30,000, we can calculate that they have a 21% profit margin. That's a very nice profit margin, and I wish all businesses had a 21% profit margin. They're doing very well. Something really important to remember, especially for businesses that are in their first year of business, any profits that you have, make sure you put money away for taxes. Your first year of profits can be a little bit confusing, and businesses can get into trouble. Not all the profits that your business makes stays in your pocket. And after your first year, you will generally pay what's called quarterly estimates every 3 months. That'll be based on the prior year's profitability. But if you don't have a prior year profitability, you don't have any quarterly estimates set up. So just make sure that you keep track, as if you are new in business and you're profitable, make sure you know roughly how much money you need to set aside for taxes. Okay, back to Puzzle Mania. We're now going to work on something called break-even point. The break-even point is the exact amount that a company needs to sell to break even, meaning they pay all their expenses, but they don't make any money. They're not losing money, they're not making money, they're just breaking even. This is a really, really important number for every business to know, because if your month is starting out and let's say your break even is 20,000 and you're halfway through the month and you only have 6,000 in sales, you should have 10 by the middle of the month. You know you're not on track that month to break even, and that you gotta do something to change what's going on so that you can at least get to break even and hopefully be profitable. But again, the profitability and all of this is very, very helpful when you understand your break-even point. So how do we calculate this? We are going to take your fixed costs, those are the things that don't change month to month, and we're going to divide it by something called a contribution margin. Your contribution margin is really the profitability of the product or service that you're selling after your variable expenses. So you're going to take your unit price, you're going to subtract just the variable cost, that's the one expressed as a percentage. That will give you your contribution margin. So we divide your fixed cost by your contribution margin, and that'll tell us how many units or services we need to sell. So when we look at this in a real scenario, I think it'll make more sense. So we know Puzzle Mania has $9,070 for their fixed expenses. We know their variable expense is 49%. So we're going to take their fixed costs, 9,070, and we're going to divide it by their contribution margin. We know that the puzzle costs $20, and we know that the variable cost is 49%. So if we take $20 and we multiply by 0.49, That'll tell us that our variable cost for that puzzle is $9.80. If we subtract $9.80 from $20, that'll give us our contribution margin, which happens to be $10.20. We're going to divide 9,070, that's our fixed cost for the month, by $10.20, and that'll tell us we have to sell 889 puzzles to break even and cover all of our costs. If we multiply 889 puzzles times $20, we can see expressed in dollars, we need to sell 17,780 to break even and cover all of our costs. That is the break even point. You can either say it in units, 889 puzzles, or you can say it in dollars, $17,780. So that is your break even. If you sell more than that, that's where your profit is. If you sell less than that, you're going to have a loss for that month. Okay, so we are going to now move on to a very similar scenario, but instead of a manufacturing company, we're going to look at Lulu's beauty salon. So this is now going to go to a service industry. Instead of selling a product, Lulu's is selling salon services. We're going to start out with the same things. What are Lulu's fixed expenses? Rent, telephone, insurance, salaries. Her fixed expenses every month are $11,420. That's quite a bit of money. So I hope Lulu has a lot of business going on. Her variable expenses are 60%, but you can see looking at this chart, the majority of that cost is in her commissions. So that's really great. As her stylists work more, they make more. So it's she doesn't have a lot of overhead outside of those stylists getting the commission. And the other stuff is pretty nominal. Shampoo, conditioner, 2%. Hair dyes and perm kits, 7%, credit card fees, 2%, and marketing, 4%. So her total variable expenses are 60%. And let's see how profitable Lulu is. So Lulu, on average, serviced 18 clients a day, 6 days a week. If we multiply 18 times 6, we get 108 services per week, and there are 4.3 weeks in the month. Her average service runs about $120. So we can talk about how do you figure out an average service when some stuff is $50 and some stuff is $250. How do we calculate those numbers? That's the type of thing that you want to work with a mentor with, or your accountant if you have an accountant that you work with. But all of these numbers you can figure out with your own business. They may not be obviously available, but we can help you calculate these things. So her average service was $120. We multiply 108 services a week times 4.3 weeks in the month times the average rate of $120, and we see that Lulu's salon brought in $55,728 for the month. We're going to now subtract our expenses. So the first thing we do is take 55,728 and we multiply that by 0.6. That's how we get 60% for her variable expenses. That comes out to $33,437. And we also want to subtract, of course, her fixed expenses. And what's left over is $10,871 of profit. Again, really nice, healthy profit for this business. If we divide that profit into her sales of 55,728, it shows us that she has a 20% profit margin. So now we also want to see what's Lulu's break-even point. Her fixed expenses are 11,420. Her variable is 60%. Her contribution margin is $120 is her average unit price, multiplied by 0.6 is $72. We subtract 72 from 120. That gives us a contribution margin of $48. So we're going to divide 11,420 by $48. And then we see we need 238 clients for the month to cover all of her expenses. If we want to see that expressed in dollars, we're going to multiply 238 clients times 120. So we see 28,560 is her break-even point. So again, you can talk about a break-even point in terms of units that you're selling or in terms of dollars that you're selling. Both they're equal, they're just a different way to express it. If she sells more than 238 clients, she's making profit. And if she sells less than that, she's going to be losing money for the month. Okay, so we have one more example. We're going to do the exact same thing. This is Walter's Window Washing Company. He has very different expenses. He works from home. He has very little overhead. It's mostly his truck lease, his insurance, liability, health insurance, cell phone, website. His total fixed expenses per month are $2,600. And he's got very low variable expenses. His main expense is gas, and then cleaner 4%, rags and towels 3, credit card 3, marketing 4%. So his total variable expenses are 24%. Living in Cleveland, we have to think about how often can windows be washed. We're definitely have to deal with weather. Winter time is not a good time for washing windows in Cleveland, and spring and fall can also be questionable. So based on weather and living in Cleveland, Walter is able to service 2 clients a day on average, only 4 days a week. Sometimes he works 7 days a week. Sometimes he's only able to work 2 days a week. But the nice thing about looking at data is you can average things out. So we know Walter's able to service 2 clients a day on average, 4 days a week. And again, there's 4.3 weeks in the month. And his average service is $300. So if we multiply 8 services a week times 4.3 weeks in a month times $300, his revenue is $10,320. If we subtract his fixed and variable expenses, we see that he's left with almost more than half, $5,243. So that is 51% profit margin. And while that seems like a wow, amazing thing, Walter has the additional challenge of managing cash flow, because in January and February, when he's doing no window washing, he still has truck expenses to pay for. He still has all of his fixed expenses. So while this seems like a very high profit margin, and it is, Walter still has to really manage his money because of the seasonality of what he's doing. So, okay, let's look at his break even with the same concept. We've got 2,600 for his fixed expenses. We've got variable at 24%. So we're going to divide his fixed expenses by his contribution margin. So how do we calculate that again? It's the unit price, which is on average $300 a service, times 0.24, 24%, that gives us $72. and we're going to subtract $72 from the average price of $300. That gives us our contribution margin of $228. We're going to divide $2,600, his fixed expenses, by his contribution margin of 228, and that tells us he needs to have 12 clients a month. Not a lot. And again, like I said, we have other things to consider when you have a seasonal business. But basically, if he has 12 clients a month, and the months that he's working, he's covering his costs for those months. If we look at it in dollars, 12 times 300 is $3,600. So that is his break-even point. Again, it doesn't address his cash flow issues, but that's his break-even point while he is working. If he does more than 12 a month, he's making profits. And if he does less, he's going to be losing money. So now we're going to start talking about how to collect financial information, and I'm going to pass the mic back to Richard.
Thanks, Chris. Let's talk about how to collect financial information for your business. The most obvious one is accounting software: QuickBooks, FreshBooks, Peachtree, Xero. There are a lot of different programs out there. You will be recording your transactions, your financial transactions, into your accounting software. So the first thing you'll do is record your revenue, which is your sales. If you don't have accounting software, a lot of small businesses don't. Finding this out is still pretty simple because there are other ways of doing it. The first and most obvious is your bank statement. As you deposit money in the bank, you know what's being deposited for sales. You'll have your own bank account for your business. You're not merging your money with your personal bank account. So everything that goes in is revenue to you. Your point of sale system. A lot of stores, retail stores, or restaurants have point of sale systems. They can identify all your revenue for you. Paper receipts. Square is an example of a program that captures your credit card transactions. And there are a couple others out there in addition to Square. You may accept also Venmo, Cash App, and Zelle as methods of receiving form of payments. Shopify, Etsy, Amazon, Poshmark, all the major retailing websites also capture this information for you. And so through all of that, every one of those methods, whether it be point of sale, paper receipts, Square, or similar kinds of products, Venmo, or similar kinds of products there, and the online sites, they all will provide you with information on your revenue. So you just take the various sources that you have and put it together, add it up, and you can collect, you can understand what your total revenue is. For costs, it's kind of similar. Again, your bank statements will show you everything that you disburse to pay for your business. So that's one area. Your checkbook will have more information. It should balance to your bank statement, though. Paper invoices. You may get, for example, an invoice at the end of the month that you're not going to pay until the following month, but the paper invoice will show you at least what you spent in advance of how you pay for it. Vendor account history. There's a lot of information in that. Your credit card bills, your employee payroll, and if you have contractors like Lulu has with her beauticians, the 1099s that you periodically create. Okay, so let's talk about what kinds of accounting are really out there. And it's a fairly simple discussion. There's financial accounting and managerial accounting. Financial accounting focuses on recording past transactions. So every time you make a sale and you record it in your online software, or you record it on a spreadsheet that you have, or you take a receipt, an invoice that you have sent to a client, or a receipt coming out of your point of sale system, whatever it happens to be, that records your past transactions. And then the thing to keep in mind on past transactions are there are strict formats and conventions. And your accountant can help you with that. One of the things that you need to understand is you might have an accountant, you might have a bookkeeper, and they are familiar with the accounting rules and regulations that all transactions must conform to. And so when we say here strict formats and conventions, work with your accountant, work with your bookkeeper to make sure that you're recording things properly. Um, any kind of financial transaction, financial accounting transaction must withstand an audit. And what that means is periodically, usually just once a year, your books need to be audited by your accountant. Your bookkeeper is probably not the right person to do that. Your accountant is. And they will identify for you any issues in the way you're recording your transactions. And we've hit the last bullet point there already. Managerial accounting is different than financial accounting. Managerial accounting is more for you to help you plan what you're going to do, and that's forecasting. Most businesses will do a forecast for, let's say, the following year in September, October, November, based on the information that they get out of their financial accounting. Now, if you're just starting out and you don't have history based on your financial accounting, then you're going to take your best educated guess based on your knowledge of the business that you're going into. So managerial accounting is more for the manager, the owner, that's you, than it is for the government, for example, which would be the financial accounting. Because remember what Chris said, that periodically you're going to have to make estimated tax payments, and that's to the state and the federal government. And so financial accounting helps you determine what you have to pay in estimated taxes, whereas managerial accounting is going to give you the ability to look at your total revenue and your total sales and your total expenses, whether they be fixed or variable, and allow you to forecast. Now, one of the organizations that's going to look to your managerial accounting forecast is going to be any lenders. They want to know how business is going, and you'll tell them that through financial accounting, and then what your future forecast is going to be. You'll do that through managerial accounting. Managerial accounting is generally simpler because you're not having to worry about each individual transaction. You're looking at numbers on a higher level, but it needs to be consistent with the way your financial accounting is being recorded. And it needs to be realistic. You can't go off and say you're going to double or triple your sales or cut all your expenses in half without having some justification behind those kinds of forecast numbers. And it's usually done by you with support from your accountant. Maybe you have a bookkeeper, maybe you have another kind of financial advisor, and it's done as a team. Okay, what each type does for you. Financial accounting produces information primarily for others. I mentioned that, for example, a lender is going to look for your financial statements. How did you do last month? How did you do last quarter? How did you do last year or year to date? And there may be other interested people, if you have investors, they will want to see something like that. Many of you, if you own stocks or mutual funds, get quarterly reports from the stocks or the mutual funds that you own. And where does that come from? It comes from financial accounting, okay? And it provides a valuable history for all the stakeholders in your business. That's lenders, that's investors, that's anybody else, other organization or individual that has an interest in your business. Managerial accounting produces information primarily for you. You build the financial model for your company and then compare that to the actual results to see what's really going on, what's going right, what's going wrong. Have you met your financial objectives that you set out in through managerial accounting? If not, where is the problem? If you've exceeded the forecast, what has been so successful that you've underestimated it in your forecast? And that's all part of managerial accounting. One of the things to keep in mind here is forecasts start out rough, but as you get more and more experience creating forecasts and using the financial accounting to improve your forecasting, they get better with time. You can use spreadsheets, graphs, or just figure it out on a notepad. And we're going to talk today mostly about managerial accounting. Okay, basic financial statements. There are three basic financial statements. We're going to go into two statements in more detail. Accountants and financial software like Quicken or FreshBooks or Xero or Peachtree or any one of those will produce for you these three financial statements automatically. They're already built in to the programming. All you have to do is click a button and the statements are created for you automatically. The first one is the profit and loss statement. It's often called the income statement. And what it does is it records all your revenues and all of your expenses and tells you whether you have made a profit in your business or not. Okay. And generally, this is produced once a month, but with the financial software, you can actually do it more often than that. As long as you record the transactions properly, you will have your profit and loss statement. Cash flow statement is similar to profit and loss statement, but it focuses on cash, not on the financing of the business. So whereas profit and loss statement, for example, has non-cash items that actually go into expenses, and I'm not going to go into a lot of detail on that. Cash flow deals only with the actual cash coming into your business and the cash going out of your business. And when you ask for your accounting software for a cash flow statement, what you get is is your business bringing in more money than you're paying out, or is your business paying out more money than you're taking in? And that's really important because even though your business may show that you're making a profit, you may end up cash short in actually operating your business because you don't have enough cash in your bank account to pay your bills. And the cash flow statement is the report that will show that to you. The balance sheet, I'm going to go through this very, very briefly, is a snapshot in time on the financial health of your business. What a balance sheet does is it shows all the assets of your business and then shows all the expenses of your business and your liabilities. And the difference between your assets and your liabilities is the value you have in the business, and that's called owner's equity. And it's a snapshot in time. Most businesses look at this maybe once a month, but definitely once a year at year end to see the financial health of their business. So, what do these statements do? Well, they help you prepare your taxes, especially when you have quarterly payments due. They produce information that potential lenders or investors request. Okay. So, for example, don't be surprised if you have a bank loan and the lenders want to see maybe once a quarter what your financial statements are. Maybe once a half, it may only be once a year. As you gain financial knowledge and gain success in your business, the lenders or the investors will request this information less often than when you're starting out. Okay. And then it helps you predict the future of your business by creating the financial model that you're going to be doing in managerial accounting. So you're going to take your past history and say, what were my January sales and what were my January expenses? What were my February sales and February expenses? And that's what you'll actually use on a 12-month basis to produce your forecast. And then it allows you to gauge the health, the financial health of your business. Okay, the profit and loss or income statement. It uses the data on revenue and costs to determine your current profitability. And that comes out of financial accounting. But it also shows you how profitable your business is likely to be over time, and that's the managerial accounting. It helps you prepare your taxes. It demonstrates to potential stakeholders that you have a realistic path to profitability, and it helps you pinpoint excessive costs or unprofitable product lines. In some cases, it may be necessary to carry unprofitable product lines so that you simply have a broad range of products that you can sell to your customers. Now, that's not only physical products like cans of soup or dresses or something like that, but product lines are also services that your business sells. So, for example, if you have a home healthcare service, the home healthcare service may actually include a service that is not really profitable to you, but you would lose customers if you don't include that in your service offerings. So the profit and loss statement will help you pinpoint the products or services that are very profitable to you and the products or services that are not profitable to you, but you need anyway. Next, Chris. Okay, the cash flow statement. It shows potential lenders or investors that you have a realistic view of your cash resources. And it's really important. The last thing you want to end up doing is run out of cash and then have to go back to your lenders or your investors and say, I have no more cash to run my business. I need a bigger draw on my loan, or I need investors to contribute more money. Otherwise, I'm going to have to go out and get a loan. And so that creates some real questions on the part of the lenders or the investors. So you want to make sure that you're managing your cash properly, and the cash flow statement is the report that will show you that. Okay, it helps you predict and prepare for cash shortages. Remember, we were talking about Walter's window washing a couple minutes ago. Walter is going to have a cash shortage in January and February and March, maybe in December as well. And so Walter has to plan out how he's going to pay for his expenses while the window washing business is non-existent or very, very slow. Now, Walter really has two ways of doing this. He can plan out his cash to make sure that he has enough money in the bank to tide him over looking at his fixed expenses during the months when his business is really not operating. Or Walter can actually also go in and do something else during the winter months to help keep his business going. For example, maybe he does carpet cleaning, maybe he does tile cleaning. There are other things that Walter might be willing to and able to do to bring in revenue. But the cash flow statement is the basis of what Walter needs to decide how he handles this. So the cash flow crunches can sink a business. It allows you to identify and plan for seasonal fluctuations, as we've already talked about. And it's a model that will enable you to view what your checkbook will look like in the months ahead. Will you have enough money to run your business or not? It helps you plan for major purchases. Let's say that you're Walter and you want to go ahead and go into the floor cleaning business. Well, you're going to need vacuum cleaners, maybe scrubbers, some additional equipment perhaps, and that could cost you $5,000, $6,000, $7,000 to get commercial grade equipment. And if you only have $5,000 in the bank, that's going to be a problem. How do you go out and buy this equipment without putting a significant dent in your cash reserve? So that's one of the reasons for a cash flow statement, and it enables you to predict how large a cash reserve you will need. In some cases, what you're going to want to do is, if you have a very large cash reserve, you don't want to keep that in a checking account because checking accounts earn either zero or very, very little interest. So it will allow you to say, well, should I be putting this money in a money market account that I can draw on, but is still earning 3% versus 0.5% if I just keep it in my checking account? So that's why cash flow statements are so important. Okay, we've talked about the major reports that you'll need and who helps you with these. The first financial service provider and the most common are bookkeepers. Bookkeeper is usually a person with an associate degree or higher in accounting. And what they do is they record the financial transactions for you. So for example, if you're not comfortable with bookkeeping, you can take all your receipts and all your invoices and give them to a bookkeeper to record. And they will record those transactions, whether they be cash in or cash out, based on generally accepted accounting principles. And you may give them permission to write checks for you, or at least write the checks and have you sign them. There are different services that bookkeepers can do. They can also estimate the taxes that you have to pay for you. But they are the lowest level of financial service provider. They're also the least expensive. Next, accountants. Accountants normally have a Bachelor of Arts or Bachelor of Science in accounting or higher. They may have an MBA. They interpret financial information for you and they give advice. So one of the biggest differences between bookkeepers and accountants is that bookkeepers do everything that, or accountants do everything that bookkeepers do, but they are also able to interpret the financial information for you and give you advice. So for example, if you're reading an income statement and you're having trouble understanding what products are profitable or services are profitable, and what products or services are not profitable, they can help you understand what products you're selling or services you're selling that are profitable and which ones aren't. And working with them, they can also give you some advice on how to turn some things around for you. The certified public accountants are accountants who have also passed a higher level of set of examination, and they're licensed by the state. So from a cost point of view, Bookkeepers are going to be less expensive. They're often done on an hourly basis. Accountants are going to be more expensive, but give you more value. And CPAs are the highest level of accounting proficiency, but they're also going to be the most expensive. Okay, let's talk about projections and ongoing accounting. Projections aren't just a one-time effort. They normally are done on a regular basis. There should be continuity between your financial projections and the ongoing tracking of your finances. So, for example, in several of the businesses that I was in previously, we did what is known as a 3-month rolling forecast. So, for example, we're in May right now, or we're in the middle of May, and my businesses would do a forecast for June, July, and August. And then in the middle of June, we would do a forecast for July, August, and September. Well, where are we getting this information from? What we're doing is we're looking at financial accounting and seeing what we've done in the past and what we're doing in the current month. Chris gave you a good example a few moments ago when she said, you know, if it's the 15th of the month and you're planning on having $10,000 in sales for the month, but you only have $6,000 in sales, you better understand why you only have 6,000, and will you make up the difference by the end of the month, or are you going to be short of sales? So you need to kind of understand all that, and using the financial accounting to give you the information for your managerial accounting, you'll be able to do that projection. So a 3-month rolling forecast is a really good idea for you. If you use an accountant, show him or her your projections to assure consistency. They can tell you whether you're on track or not. And if you're using accounting software, compare its financial reports to your projections. Contact customer service if you don't understand the differences, or work with your accountant. Most companies have an accountant or a bookkeeper, and they can help keep you pointed in the right direction. Okay, collaborating with your accountant. Work jointly with them on your chart of accounts. The chart of accounts is very important. Virtually every industry in the United States has its own set of accounts, and that's called a chart of accounts. And it's the way you classify your revenues and the way you classify your expenses. And that chart of accounts comes under something called the Generally Accepted Accounting Principles. You'll hear the term GAAP, GAAP. That's Generally Accepted Accounting Principles. And the chart of accounts for each industry conforms to GAAP requirements. Well, where do you get the chart of accounts? In most cases, the industry trade association that represents the business that you're in is responsible for establishing and maintaining the chart of accounts for your business. And so you can get the chart of accounts, or your accountant or your bookkeeper can get the chart of accounts, if they don't have it already, from the trade association that represents your industry. Regular reviews of the financial statements and reports for trends and anomalies are something that you want to do with your accountant or bookkeeper. That's really important to stay on track. If the results are unexpected, drill down into the financial data to find out why. And that's one of the reasons why accounting software like QuickBooks or Xero or FreshBooks or Peachtree, any one of those, is so helpful, because with just a few clicks, you can actually narrow down and find out what's going on with the business. Have your costs go up, but your prices haven't? Have your revenues increased, and your costs have remained the same? So there are a lot of reasons for that, and your accounting software especially can help you with that very quickly. If you ask an accountant to do it, remember, you're paying the accountant by their time, so they can do it for you, but it could end up being more expensive for you. How do you use the data? Well, you use the data to identify your profitable product lines or your least profitable product lines, the most profitable customer segments. Um, Good financial data will also be broken down by your customers. Okay. For example, I have several clients that have both wholesale and retail customers. And so using the financial data, they can see which customer segment, wholesale or retail, is most profitable for them, and they can determine why. And then finally, it helps you determine potential problems. Chris? Okay, we're almost at the end. Um, Here's a simple financial glossary of what is revenue, what are expenses, profits, what is the definition of profit, and how do you make that work for you? Fixed expenses, what are variable expenses, what's your break-even point, and what's your contribution margin? You'll hear the term contribution margin a lot when you're talking to your financial advisor. Okay. It's important to also mention that everybody who attended this workshop today is going to get a copy of this slide presentation and a link to the recording. And that'll come out, today is Thursday. It may come out tomorrow, most likely. It will come to you next Monday or Tuesday. Okay, Bob, were there any questions in the chat?
No, I actually got one. Let's see. Um, Fantastic job. Thank you so much. So that's a great
Okay.
one. And other than that, I do not see any questions in the chat, but let's open it up for a couple minutes and see if we get any. So if anybody has any questions or concerns or wants to know anything, please put it in the chat and we'll look at it real quick. Going, going, gone. All right. So
No, wait a minute.
there we
There's
go. I
one
got a
there.
couple. We
Um,
got a couple.
Okay, so
Okay.
let's take the first one that came up, and that was
You got
uh,
this?
how to determine the percentage, the variable cost percentage in form of dollars. Chris, do you want to take that?
Sure.
Since
I think
you
that
got control of the slide.
the main thing that you are going to need is history. So what you're going to want to do, maybe again, let's say you're a salon. What ends up happening to get the best pricing on things, you might order shampoo once every 3 months or 4 months or 6 months. So what you want to do in all of your categories is the more history you have, the more accurate your data is going to be. So you can do it with just a couple months and average things out. But if you have any of this accounting software, it's literally done in seconds. It will show you percentages. It can break down things. If you don't have the accounting software, then I'm going to say even more, you want to get a mentor who can help you kind of weed through, how do I collect this data? How do I look at my expenses? So you basically look at all of the money that's going out of your business and first divide it into two categories. It's fixed or it's variable. Once you've got that divided, now you're going to drill down into what specifically are the average variable costs. So it's a little bit complicated to figure out what is your average price when your prices are all over the place. But let's say you bring in $25,000 in a month and you have uh, 87 services. You will divide the dollars that you brought in by the number of services, and that will give you what's your average cost of a service. So again, some months might be a little bit different. If you have a month to do that average, then you can look at the prior month. You can also do a 3-month average and say, is this really looking consistent or is it all over the place? So there are many, many things. There's seasonality to consider. There are, influxes of, you have more labor sometimes, you have less labor. There's a whole variety of things. So there's a lot of moving parts, but overall, if you have and can get a good number of months of history, all of this can be figured out. This is another reason why I just want to mention, if you are new and getting started, keeping completely separate business accounting from your personal accounting also makes this phenomenally easier. If you have a credit card that you use for personal and for business, you got a line item, you don't know exactly what you spent on what, it's hard to see at a glance. If you only use one card for business, you know exactly what your charges were in any given month. So it's much easier. So definitely separate bank account, separate credit card, keeping, all of your business transactions, both money in and money out, completely separate. But again, some of this stuff, it seems a little bit complicated, but once you start averaging things out and putting the stuff together, it starts to make more sense.
Yeah, and any question that we don't get to today, your SCORE volunteer, your SCORE mentor will be more than glad to go into detail with you. Some of these concepts are not easy to understand in an initial presentation, but once you work with them a little bit, you'll understand not only how to calculate them, but the logic behind it. Bob, I think we have time for one more question.
Yeah, there's actually two in the queue if you want to try looking at both of them real quick. Can I reverse engineer this presentation to price services, or is there a SCORE webinar to help determine sales price?
There actually is, there are several resources within SCORE on how to price your products. And if you, or services. If you go to just, either score.org/Cleveland or score.org, you'll see on the homepage a magnifying glass, which is a universal symbol for, do an inquiry. And you can actually type in product pricing or service pricing into that, click the magnifying glass, and you'll see a whole series of resources, recorded webinars, articles, blogs on how to price products and services. And then you just go ahead and open those up. Again, your SCORE volunteer can also help you with that in detail, because each industry is going to be a little bit different. So the recorded webinars will give you a really good idea on that. The blogs, the articles that we have in there will give you a really good idea, but your SCORE volunteer can help you actually refine the strategy.
So here's another one. I'm not sure we can answer this today or not, but what about commissions on sales that are mixed? So for instance, percentages based on flat dollar and et cetera per product.
Right. And the best way to handle that is just to average it out. If sometimes what you have is a draw on commission, where your salespeople are earning in effect a base salary, and then they have commissions on top of that. But that the base salary is a draw on future sales, on future commissions. So it becomes a little bit complicated. Really good to work with an accountant on that, to develop the tracking methodology that you need. But the idea here is, over time, and Chris has talked about history, over time, you will kind of develop an average to what your commissionable people are earning, and that's what you'll use to average to do your forecasts.
All right, I think we have covered all the questions. And so, ladies and gentlemen, thank you so much for joining us. Richard and Chris, wonderful presentation. I think people got a lot out of it, particularly as I look at the comments that came in through the chat. So have a great day, everybody, and look forward to seeing you on more of our workshops. Take
Thank
care.
you for, oh, by the way, our follow-up to this is next week on next Thursday. Join us for that, and we're going to talk about some strategies that you can use to evaluate things like discounting and couponing, and how to evaluate the financial success of advertising programs, all kinds of strategies that we're going to go into next week. So join us for that as well.
Excellent. Thanks so much, Richard. Thanks, Chris. Take care.
Thanks. Bye.
Bye.